Ladies and gentlemen, sorry about the delay. We now have recording thanks to Teaching Technology Services, and so we can go. That's fantastic. Now, I hope you're seeing a window that says Business Finance and the PowerPoint for today. That's terrific. What I want to do is start off by actually going over something not to do with our class today, but with the assignment. Some of you may have downloaded the assignment sheet, and you'll notice that the assignment is due now, and it's actually only after I uploaded it on Friday night that I discovered I wasn't actually supposed to give it to you for another week or so. So you've actually got it ahead of time, so I hope that doesn't cause trauma. What it means, though, is that if you know what you're doing, you can get into the assignment early. There's no time limit on it, so you can do it however you want, as long as it's submitted by the due date. While we're talking about the due date, though, I'm thinking of organising a different submission system. I'll be letting you know probably in the next few days about that, maybe early next week. The reason is that with the corona adjustments, a lot of this stuff is fairly experimental. You'll notice that the assignment has been, hopefully you'll think it's been a bit simplified, in that in the description we said it was going to be calculations and theory, and when I looked at it closely I thought, well, it's always an awful lot of calculations and only a little bit of theory. So I decided to streamline it so that it's doing the calculations now, and that way we can focus on the theory in the exam, which I think would be a better use of everyone's time. The nice thing is, especially giving it to you early, is that you can go through what's required in the assignment, and you'll find that it lines up with the weeks we've done. It's examining weeks 1 to 5, so it's examining this week as well. And so if you're sharp, you might want to see what questions in the assignment relate to this week. And to help you with that, I'm going to just take you through how to use the assignment. I'll just put away some of these other bits of distraction so we can just concentrate on the file. When you open up, you get something like this turning up, and you'll find there's not very much you can actually do on this page. And the reason for it is that the page is asking you to enter your student number into cell D5, and then use the values below in the questions on the next 2 worksheets. So that's what the game is all about. And you'll notice this spreadsheet has 3 worksheets: the student data set, questions 1 to 3 and a few other bits and pieces, and then question 4.1 all by itself. Okay, let's just walk you through what's involved. You put in your student number. I'm just going to make up a number here, 1, 2, 3, 4, 5, 6. And you'll find that when you hit return after putting your numbers in, we're only really interested in the digits in your student number, but you can put the S or the Q or whatever letter prefixes it if you like, doesn't make any difference. But the number, your student number, the digits in it, are the bit that this system is really looking for. Hit return, and what turns up is a whole bunch of numbers, a whole bunch of values. These become the values for the parameters of the various computations that we've been doing over the last few weeks. We're going to be doing this week, and these are the numbers that you're going to be using in the questions. Okay, as you look down here, so as to make it really, really hard for people to do silly things, I've set this page up so that you actually can't touch any of these cells. And the reason is, the last thing you want to do is be given your nice unique data set and you're supposed to be working off a number, let's say 72,200, and for some reason, you go off for a coffee, the cat walks across your keyboard, and you mess up that number and you do some really marvelous mathematics, but you actually do it on 77,000 or something. And I mark you wrong, and you get really sad, and I don't want that to happen. It's really important that you use the data that's allocated to you by your student number. Just to illustrate, if you put a different student number in, you'll get a different data set. And so what that means is everyone has their own data set, so everyone does their own calculations, everyone gets marked on their own cleverness. So that should be fairly easy. Obviously, don't share your stuff with other people, always good advice. But here, if you do share your stuff with other people, it's not going to make a great deal of difference anyway, because if they use your student number or some other data set, they'll get a whole bunch of wrong numbers, which I don't want anyone to do. Okay, that's the first page. That simply gives you your data set. Now we get to where the questions are. The questions are set out by chapter, which is, by week. So in the first week, we've got questions 1.11, 1.12, da-di-da-di-da-di-da-di-da, down to 1.5. So there's a handful of questions there. Here are the number of marks allocated to them. You'll find that question 1, in other words, week 1, contributes 8 marks to the assignment. The assignment all up is worth 30 marks. And as we go through, you'll see from week 2, we've got a few questions or a couple of questions. Then we go to week 3, we've got a bit more. Week 4. Week 4 is a little bit tricky because it actually runs onto this other page. And then week 5. So today, what you're going to be covering, or what we're going to be covering in our workshop today, will give you the smarts, the practice, the understanding of a lot of stuff, but amongst all that stuff is going to be how to do these 3 questions. So it's probably wise for you to be on the lookout. Okay, how do you do these? Each question, let's look at question 1.1. Agnes deposits inheritance of $A into a bank account that earns B% per annum interest, calculated annually. Agnes deposits an inheritance of $A that earns B% per interest. What will be her balance in C years if interest compounds? Okay, so you guys can dig out the calculations we did for compounding interest, and we've got an inheritance of $66,600. It's going to be earning 2.3% per annum, and we're going to be keeping it for 8 years. So we'll come in here and we can write out an equation that might look like $66,000 times 1 plus that divided by 100 raised to the da-di-da-di-da, and there you go, 79,888. So if your student number happens to be student number 1, 2, 3, 4, 5, 6, then I've just done the first question in the assignment for you. For everybody else, you'll have to do it yourself. Okay, what happens if you get the wrong answer? Well, you don't get any marks. What happens if you use the wrong data? Again, you don't get any wrong marks. Remember, right at the beginning of the term, I said I'm preparing you guys for the big bad world of business, professional life and so on, where people aren't interested in how you do it, they just want you to get the right answer. And that's pretty much what I'm going to be asking you here. I'll give you as much help as I can, but I want you guys to get the right answers. The way to do that is also to pull out your wonderful little calculator, practice, or rather check what you do with your spreadsheet. If you do it by the spreadsheet, you don't have to use the Excel spreadsheet the way that I did, but you can just calculate it with your financial calculator or your scientific calculator, whatever, I don't care, as long as you get the right answer. And if you really want to make sure you get the right answer, I'd recommend you do it on Excel and also do it on your calculator. And that way you've proven to yourself that you deserve the marks. Couldn't be easier. Okay. Now you'll notice that Excel is formatting all that for you. I think some of the questions will come down and that's all formatting. Most of them are dollars. I think a couple of them are percentages. That's, where are they? There you go, that one comes up as percentage. So as you put in your answers, you don't have to worry about formatting and all that sort of carry on. To make it a little bit easier for you, I've reproduced the data set here on the second page here, so you don't have to keep going from sheet to sheet to go back to your student data set. I do recommend that you get to know how to open a second window, open a new window in Excel, because it's a really handy tool. Okay. I have put a little shortcut into my Excel program because I use this facility so much. So I'm just opened a new window. Gives me two views, if you like. I'm going to go back to my student data set. And so here on my computer, guess I'm spoilt with some nice big monitors. So if you're working off a laptop or what have you, you may not be able to put all this stuff on the same page. But there you have it. That's the first page, which is the data. Here's the second page, which is the questions. Right. I'm merely doing that to show you that here is for student, well, actually 555, 555. I've got A, B, C, those parameters here, and there they are reproduced again. One thing I will warn you about, though, I've tried to make this pretty idiot-proof. I don't know how much of an idiot you need to be to go and make mistakes with this thing, but, you know, some people might be able to sort of answer that puzzle. Really important that you don't use the wrong data, right? Because you can get to these numbers, you see I can select them, and when I wrote up this equation, I've written it simply in terms of the parameters. Because you can select them, you can also mess them up. Right? It doesn't change your unique data set. You still should be working off a value for A of 66,600. But for whatever reason, I put the wrong number in. Again, the cat might have run across my keyboard when I was off having a coffee. It's your responsibility to make sure that if you do change these numbers, you don't use them. Okay? So a little bit of data checking could be really useful. Won't affect most people, but I would hate to see you lose marks, again, because of the cat crawling across your keyboard or what have you. Okay? And sometimes you just, you know, click the wrong button as you're doing these things. So it happens to everybody, but just be wary. If you look at these things, they do have little equations written in them. So that's where they're getting the data from, which is exactly sort of off this page. So if you do mess something like this up, I think you can probably even put it back by doing something like a fill back, okay, which is really nice. So I've just fixed my own problem there, okay? Remember I said to you, you're allowed to make any mistake you like as long as you're the first person to find it and therefore fix it, right? So I've made a mistake there and now I've fixed it and Bob's your uncle. Okay, we're all happy. Okay, I think that should keep you moving with that. You'll find this assignment in the assessment window in the Moodle page. So go to assessment and look for for the spreadsheet. I'll just see if I can move this into this window here. Close all those. Come down. Assessment. Open up that window. Hang on, where is it? Oh dear. I don't want examples. Okay, now I've got myself confused. I'll check that maybe through the break and I'll get back to you. Okay, stay tuned. Okay, any questions about doing the assignment? Then we'll move on to our real work. All good? Okay, let's put that away. I don't want to do anything there. And bring that out because that'll be handy. I'll bring out the PowerPoint for the day and away we go. Okay, this week we're going to be looking at risk and return. Now we've talked about this a little bit in the past. You know, we've talked about standard deviation and variance and the fact that finance is all about the future and all that sort of stuff. They're really important things to be aware of. Okay, today we're going to be looking at some applications of that. In particular, we're going to be looking at the capital asset pricing model, which is a really handy, useful kind of conceptual tool. I'm very, very fond of it as a conceptual tool, as a mathematical way of solving the problem of risk and return. Not so impressed. However, we have to learn how to actually manage the thing and how to work with it. Not hard. And it's really when you understand the mathematics of these tools, it's only then that you can really get, if you like, a rounded understanding, or the equipment to really decide for yourself what the thing is actually telling you. So I'll try and cover both of those for you as we go along. But just keep in mind, learn the maths and get on top of the maths first. And then after you've mastered the maths, then you can come back to the concepts and say, is this really doing what I think it's going to be doing? Okay, let's jump in and play with this now. Capital asset pricing model. I hope you guys have already read about this in the chapter. That's probably about the best way. It's an elegant model. It makes the claim that the return on an investment is going to rise with the risk. And it makes that claim, especially in the textbook, concerns me a little bit. It makes the claim as though there's some magical factor happening which kind of causes the return to get higher as risk gets higher. It actually turns out that it doesn't have to be like that. You can have risky things that just blow up in your face and you go bankrupt. The fact that something's risky doesn't mean that you're going to make a lot of money out of it. A lot of people do. In finance, we tend to talk about the psychology, to a certain extent, of investors. We talk about investors having different attitudes towards risk. We talk about risk-adverse investors. In other words, investors that don't like risk try to keep away from it. They go for the nice, stodgy, normal, reliable things, put money in the bank. They wouldn't sort of put money on the horses. And then you've got the other kind of psychology, risk seekers. And the risk seekers get a bit of a sniff for a high return, go into places where other more sensible people might do it. And they're really gamblers, kind of wearing Italian suits and wanting to look like they're smart, but they're still gamblers, and they're money market operators and things like that. I had a good friend once who had a very successful career working for one of the major banks as a money market dealer, and he got out of it. And I was sort of speaking to him once, and this is when I was kind of a bit younger and greener with a lot of this stuff. And I said, well, tell me about the money market. I've known some people that work in it, but I haven't actually dabbled myself. It looks a little bit sort of creepy, even though it's very high-flying stuff, working money market, marvelous. And he said, yes, Gary, you know what gambling is? That's what money market trading is. High risk, high return, relatively high risk of going belly up. And we've had some pretty spectacular failures in the past where major banks have had people hiding in little back rooms with computers and betting on different markets, especially the money market. And often they do well, and then sometimes they don't. And the behavior is all very much like gambling. Anyway, that's a story for another day. I want to get too far in it. The point for right now is that while there is a tendency for riskier investments to pay higher returns, the reason for that isn't set in stone. It's not part of the nature of the thing. Dogs bark and cats meow. That's the nature of dogs and cats. What's the nature of risky returns? Well, they're risky. Does that mean that they make a lot of money? No. The curious thing about it, though, is that when you've got some risky return, because, depending on how risky it is, sensible people may not bet on it, may not invest in it. It means that to get investors, you have to sell the thing for a pretty attractive price. And so the upside tends to be fairly high. If it succeeds, you make a lot of money. If you fail, it doesn't cost you too much because you haven't sort of bought too much. So risky shares in companies, for instance, tend to be cheap. And they're cheap because no one's likely to want to buy it very much when they've got a good chance of going, losing their money. Okay. So yeah, there's a kind of tendency for risky assets to make a higher return, largely because they come at a discount. Okay, capital asset pricing model capitalizes on that, or it exploits that tendency. Now, the really tricky thing about the capital asset pricing model, like a lot of these theories, is that it puts on the mantle of mathematical precision and mathematical insight. And it does that by naming the quantity of risk. And it names it with the name of beta, the second letter of the Greek alphabet. Why it's not alpha, beta, gamma, delta, epsilon, one of the others, I don't know. But beta is the name it comes to us with, and we just remember that. And if you're working anywhere in finance, you'll find that people are talking betas all over the place. Beta is considered to be the measure of the riskiness of an investment, and most specifically, a share investment, a share in a company. We talked about that in the first week. We're going to be talking about share valuation and so on as we go along today. Beta is quantified in the capital asset pricing model, and this is where a very useful seat-of-the-pants common sense truism, higher risk tends to offer at least the sweetener of higher return, where it turns that truism into a quasi-mathematical relationship, as rigorous as Newton's laws of physics. Okay, and that's where I would say the wheels come off, because getting beta calculated is really quite tricky. And as I think I mentioned before when we were first talking about risk, the one thing we know about risk is we don't know anything about it. I don't know what the interest rate's going to be next week or next month or the end of the year, or the inflation rate for that matter, or whether or not there's going to be some earthquake and sort of swallow up half of Qantas's airplanes that are parked on the ground because of the COVID sort of restriction. I don't know. That's what the future is about. That's what risk is about. So it's actually hard to quantify. Not only hard, it's impossible. So what do? We use what economists do very often when we really want some bit of data to fit into some equation which is going to give us certain knowledge about the future. We don't use the data itself because it's not available, it's impossible. We use what is called a proxy. And in this case, the proxy for risk, which we use in computing beta, is the variance of the uncertainty in the historical returns. Now, a few weeks ago, we looked at the way that I can look at an investment, say shares in a company or a piece of property, and I can say, well, over the last 5 or 10 years, the dividends out of that company have gone up and down, and I can do a standard deviation, variance, and all that fancy statistical stuff, and that's fantastic. In the capital asset pricing model, I take that historical lumps and bumps, I calculate the variance, and I scale the beta to the variance. If the variance is high, the beta will be high. If the variance is low, the beta will be low. How do I calibrate beta? Well, to calibrate any line, we need 2 points. That's, year 9 mathematics or coordinate geometry. And in this case, the 2 points on the CAPM line that we use is the risk-free rate, in other words, the return of a investment that has absolutely no risk. And we'll talk about where that comes from shortly. And the second point on our line is the rate of return for the average of the whole share market. Okay. We call that the market return. That bunch of shares, equities, that is the, if you like, the whole basket of shares that's being traded, let's say on the Australian Stock Exchange. And what we say is that the beta of the market, the share market, the basket of shares that is just the market, is going to be assigned a beta of 1. And so we work out the historical variance over the last 10 years of how that basket of shares has performed, good years, bad years, and so on. We average them all out, work out what that variance is by using the mathematics we gave you a couple of weeks ago, and then we scale that back to 1. So if the variance of the share market, I don't know, is 3, then we scale everything back to 1, so we divide it by 3, so we get some other share. And if it's got a variance of 4, for instance, we've divided the market by 3 to get it back to that unit beta. And the particular share we're looking at with the variance of 4, we simply scale it back the same way. So if we divided the market by 3 to get it to 1, then we're going to divide the particular share we're looking at by 3 also, and that gives us a beta of 1.333 in this particular case. Okay, that's pretty simple mathematics. Okay, that's the way the beta works. It's based on variances, and it's applied by scaling everything against the risk-free, the market risk, which is the All Ordinaries. The capital asset pricing model is a very popular model. It's applied in different countries. And so if we were having this conversation in the United States, we would be talking about the basket of shares, the performance of the American stock exchange. Typically, that's sort of focused in New York, and we talk about the Dow Jones index, and you've all heard of that. And if we were in Japan, we'd be looking at their basket of shares and so on. So it tends to be local to the extent that we're basing it on the country that we're analysing. The Australian Stock Exchange, like other stock exchanges, issues data that gives you the beta of the different companies that are listed. So Commonwealth Bank, BHP, you name it, company, anything that's listed on the Australian Stock Exchange, you'll be able to go to the Australian Stock Exchange and get their beta, which is really nice, because it will show you that maybe Commonwealth Bank is a bit safer than the market, so we'll have a beta of less than 1, and maybe some gold exploring company has got a beta of greater than 1 because it's more risky than the big basket of shares. That's all pretty straightforward. Now, I've talked about beta as coming from the variance and scaling the variance and all that sort of stuff. That's one way of, okay, just excuse me for one moment while I get rid of this call. I won't be able to take this call. So let me put that away. Okay, sorry about that, gentlemen. Where were we? And ladies. Excuse me. Capital asset pricing model. Okay, beta. Okay. What do I want to do? I'll just go through there. Now you can read through that. We want to get down to this equation here, and this is really the way that the capital asset pricing model operates. I'm going to come back to that slide. I want to come down and have a look at this fellow here first of all. This is slide 11. Okay. It's a very simple graph. Now, you've already had sort of simple graphs like this if you've done economics so far and so on, and economists love graphs. The capital asset pricing model is a good example. Okay, the red line here is referred to as the market line, the security market line, and it runs from the risk-free, in other words, a beta of 0, no risk at all, up through the market portfolio, which in Australia is the All Ordinaries basket of shares. Different companies, it's different baskets. Okay. And low risk investments are sort of down around here somewhere, high risk are up around there, and the TAB is probably off around where the bulls and cows are living. Okay. that's the whole market. That's not very useful because there aren't a lot of people that have got a investment which represents every market on the stock exchange. Some people do. You might be a bit of a risk seeker, so you might be likely to invest up here, or you might be risk adverse, so you'll be more likely to come down here. Okay, we've talked about the market, the ordinaries, the beta of 0, how that's scaled for the risky asset equal to the average asset, average investment on the stock exchange. People should be sort of saying, well, what about this risk-free rate? Wouldn't I like to invest on something which has got no risk at all? And then you can ask, well, what really does? Just remember that our income, our payment, if you like, the wealth that we get out of investing all comes from valuing the future. And so where do we go to value the future in a way which has absolutely no risk at all? The answer to that is the closest we can get is government bonds, government debt. Now, we've already talked about debt and bond valuation and so on, so we've done that in the previous week. Here we're talking about government debt. And why do we choose government debt? Really because the government in any country is considered to be the most reliable, the most trustworthy financial institution in the place. Basically, if the Australian government goes belly up and stops paying its bills, you're going to have an awful lot more to worry about than how your investment is going. Okay, we might have BHP or Combank or who knows what go belly up. Hope they don't. But if it happened, and we'd say, oh, well, that's unfortunate. That's just what happens in business. But the Australian government, wacky deal. Okay. So we use the 10-year government bond rate, the rate of interest, the rate of return on bonds from those calculations we did the other week as our risk-free rate. And we then calibrate that to the share market. Let's go back up to this equation. Okay, if we go through what those different elements in the equation make sense, it looks like a fancy and very ugly equation, but in fact it's a very simple linear equation. Let's look at a worked example. I'll get you to read through those. I wanted to work through an example. Now that's actually what I'll do. I'll make up some numbers and just illustrate how the maths works, just to hopefully illustrate how easy it is. Government bond rate. Let's say that's coming in at 1.5%. Market return, let's say that's 5%. Know what it is. Okay. And I'll say I'm analysing an asset beta of 1.3. Okay. That's the problem I've got. And I want to work out what the expected return. Expected return on that particular asset, okay? Applying that equation, expected return on this risky asset is going to equal the risk-free rate, 1.5%, plus, open brackets, no, not open brackets just yet, the beta of the risky asset times, open brackets, the market return minus the risk-free rate, close brackets, hit enter, and we might just format it to make it look pretty. Okay, what are we saying there? If we know the riskiness of a particular asset and we know some characteristics of the financial market that we're operating in, then we're able to calculate the expected return. Okay, using the capital asset pricing model, assuming I know this magic number here, which is a really important number. This is the beta number. Okay. And we can work out that beta number a number of different ways, but in the kind of examples you're probably likely to be getting, often the beta will be given to you. However, it can come from variance. A big question I'd like to, I keep coming back to this and you might get bored with it when I keep telling you, is that is beta really a measure of risk? It's a measure of the past variance, the past uncertainty, the ups and downs. Is that going to be reproduced into the future? Is BHP going to operate as well into the future in our corona corrupted world? Who knows? Even without corona, do we know that BHP is going to flourish in the way that it did over the last 5 or 10 years? I don't know. Maybe we might sort of, I don't know, sell all the things that BHP does to China or something, and so BHP might just disappear off the map. We used to make pianos and shoes in Australia, and now we don't. So those companies, I think the Beale company made pianos. Is the past performance of Beale before they got, wound up and sold off any indication of where the Beale company is going in the future? Okay, and the answer is we really don't know. Okay, so is the past variance really an indicator of the beta, of the riskiness in the future? Well, in good regular times, yeah, might not do a bad job, but realistically, it's a bit ambitious to say that's really what's going to happen. Okay, that's your capital asset pricing model. It's really good as a conceptual tool because it does cement in our minds the way that risk does tend to give this margin of return. And the other side of it is that it sort of encourages us not to pay too much for risky assets. Very important. Okay, in your own time, you may like to go through the worked examples which are in the PowerPoints. You're most welcome to do that, and you'll have this example. I say we just worked out sort of fairly quickly, so hopefully that will illustrate it for you. Okay, capital asset pricing models for a portfolio works pretty much the same way. I'll just point you back to what I think we did last week, where we were looking at weighted averages. And for those of you who are a bit mathematically inclined, you'll sort of twig to the way that really what we're doing is doing the equivalent of a weighted average to get a portfolio. What we'll be doing is taking the betas and the performance from the components in the portfolio, looking at their variance and so on, and coming up with the result. Okay, I'll let you read through those in your own time, especially since we're running a little tiny bit short of time. Yeah, we can do one of these examples. Okay, let's work through that. Return rate. Expected return for a portfolio is 20%. Risk-free rate. Da-da-da. What we're doing is working out the return here for the various components. I'll leave that example for you to go through yourselves, I think, unless somebody particularly wants us to go through. What I'm thinking of doing, so I really want to get on to chapter 7, is because you guys have got copies of these, right? We'll move on to chapter 7 and get that going, because I wanted to go on to working with the share valuation and so on, which is going to take us a bit more time. And with that, what we might do is we'll move on to share valuation now and just get a little bit of a start on that. We'll run up until about 3 o'clock on share valuation, and then we'll take a break. Okay. Let's look at share valuation. What is a share? A share, we've in the first week we introduced the different business forms, sole traders, partnerships, and companies. And when we looked at companies, we said that they were independent, legal, and economic entities. And how do they get their money? For the company to get started, they need to have cash being put into them so that they can buy the things that they need. If I want to, I don't know, mine coal, I will need trucks and excavators and conveyor belts and offices and all sorts of things in order to dig my coal out of the ground. So I need all of that machinery and that equipment, that real estate and the buildings and whatnot. How do I pay for it? There are two ways of paying for things. One is through the owner's contributions, what we call equity, and the other is by borrowing money, debt. In the case of a company, the equity comes by other people, other legal people, sometimes individuals, sometimes other companies, who contribute cash into the business to become part owners. They're referred to as the equity owners, the shareholders. And the shareholders own shares. And we all should be, I guess, familiar with the idea of a share. A share is a proportional ownership in the value of the company. When we think in terms of the value of a company, we end up with a little bit of a sleight of hand in the way this is often described. Often when you read the textbook or other textbooks and so on that are introducing the notion of corporations, of companies, gives the impression, a very real impression, it's probably not a bad idea as a starting point, that as shareholders, you own a share, a little percentage of the company. If I own 1% of the shares of, I don't know, NRMA or Commonwealth Bank or BHP, it means that notionally I own 1/100th of the assets of that company. Often the company will get started by inviting people to invest in the company, to buy the shares. And if the company, let's say it raises $100 million, buys $100 million worth of things, real estate, machinery, computers, office space, whatever, then at that point where the company just starts, assuming we can actually sell all that $100 million worth of stuff for the $100 million, then, yeah, sure enough, at that point, I've owned 1% of $100 million, therefore there's $100 million worth of the company's capital assets or their assets in general that I own. So notionally, if the company was to wind up immediately, then I would be able to take my $1 million back. That's all fairly simple and elegant. However, once you, I don't know, you buy an excavator and it might be, I don't know, $50,000 for a cheap one. In the showroom, you drive it out of the showroom and you'd only be able to sell it for maybe $80,000. So what's the real value of the excavator? Well, I might have put my $1 million into the company, but if I go and say, well, I'd like that excavator and these other things, and it sort of adds up to $100 million worth of assets that the company has bought when it started business, I'd find that immediately my investment would actually be worth less than $1 million in some cases, substantially less. So that's kind of frustrating, could be a bit disappointing. But it points us to the real reason that people invest. They don't invest so that they can say, I've got a bucket of gold, which is the one commodity that seems to hold its value fairly well. They invest in the company because they hope the company is going to be paying them dividends and their share value is going to increase in the future. And so the reason I invest is not so much to have a share in the static capital assets or total asset structure of the company. The reason I invest is that I want to have a share in the profits, in the dividends. And so it's a kind of conceptual point that my real focus of ownership is not on the asset value, it's on the income value, in a sense. And if you get your head around that, it gives you a great head start in understanding how share valuation works. Okay, this is equity. Debt we've dealt with last week. That's other dollars that come into the company. The thing about debt is that debt always comes with a fixed interest rate. And so I can calculate what my obligations are around debt pretty much immediately. If I take a home mortgage out at, let's say, 3% interest or what have you, and I borrow $1 million, I know that each year I'm going to be charged 3% of $1 million. What's that? $30,000 in interest, rain, hail, or shine, whether I use that real estate productively or not. Okay, so it's kind of certain. Whereas the equity, if I borrow that $1 million in order to buy a farm, for instance, put in some of my own money, borrowed a whole lot of other people's money, and bought my farm. The reason I own the farm is not simply so that I can stroll about in gumboots and a Kubra hat. The reason I own the farm is so that I can make money from the farm. So that's the focus. And I'm really looking at getting that out. I have to pay the bank off a certain amount and everything else goes back into my pocket. In this equation here, or this relationship here, debt and equity, debt plus equity, equals the assets of the company. Very simple equation. And it's that simple accounting equation which we never get too far away. Assets equal debt plus equity. And we'll be coming back to that from time to time. Okay. We're looking specifically at shares in the company. We're not talking about debt this week. We've talked about debt in previous weeks, so we don't have to worry about it now. When we look at the shares, there are ways of buying shares, two main ways of buying shares. One is to buy brand new shares in a brand new company, and that's called the primary market. The initial public offering is the balloon going up on the company, and everyone's invited to come along and put in their money and get in the excitement of the new company. And so the primary market is when you have new companies that are coming up. And we talk about IPOs often, and there's a whole strategy for getting initial public offerings kind of off the ground. And there's a certain amount of theory and strategy attached to that. Far more shares, however, get traded on the secondary market. You can think of these as second-hand shares. And the reason is that people buy their shares from the primary market, from an IPO, and then they hold them for a few years, and eventually they get sick of owning those, or they may want to buy into some new adventurous company, and they sell their shares. They sell them on the secondary market. When we look at the Australian Stock Exchange, we're looking primarily at a secondary market. Are second-hand shares any worse than new shares? Well, their risk and return profiles is quite different, and to a certain extent the strategies involved in owning them can also vary, again depending on your risk profile, whether you're risk adverse or risk seeker. A lot of people like the primary shares because they are a bit like betting on the TAB. Lots of promise, no guarantees. And you can make a fair bit of money on the primary market. And so some people simply focus on the primary market because they want that more exciting return. But there are other people that simply want to prepare for their retirement or what have you. They're not sort of betting, they're investing. And so the secondary market becomes more important. Okay, I think we've talked about some of that. You can read through all that just as well as if I read it out to you. And it's worth definitely read through this stuff, right? It's just like the details. It's about as exciting as reading a telephone book. But if you're not familiar with it, it is really important to be aware of. And I think most of the terms should not be a surprise for you. Okay. Reading the stock exchange. Okay, won't worry about that too much. I'll just highlight here, when we're looking at the listing of existing shares, this is primarily for the secondary market. There are a couple of things that you're really looking to learn from looking at where the share market is going. You're looking at the two ways that shares make money for you. One way is the dividends coming out of the share. Every year the company will pay, hopefully, will pay a certain number of dollars per share to each one of the shareholders, and that's your primary form of income. As well as that, the share, hopefully, will be increasing in value over time. So it's a capital appreciation. And that's another way of making money by owning a share. In some cases, some companies consciously aim to maximize the increase in the value of their shares. For instance, a strategy that a company can take, given that it's working as hard as it can, physically, mining, brewing, baking, whatever it does, it can be working as profitably as it can, but when it gets to the end of the year and it's thinking about its dividend arrangements, some companies might say, well, we think our shareholders would really like a lot of capital gain. They're not interested in dividends. That could be the sort of investors, say, who are looking for their retirement. So they're really saving for their retirement as a form of superannuation fund. Okay? Now, if I'm doing that, I'm not really interested in if I buy money in, say, BHP or what have you. I don't want them to pay me a dividend right now. I prefer for the shares to become more valuable for when I retire, and I want to sell them off. In fact, having a dividend today might even be positively inconvenient because I have to pay tax on it. And I may not want to do that. So some people prefer the shares to increase their wealth by getting more valuable. Other people want the shares to increase in value by providing a dividend. After I retire, for instance, my strategy would be completely different. I might own my shares in whatever company it is, but I don't really want them to increase in value just so that they can be, passed on to my grandchildren or what have you as inheritance. I want then a nice healthy dividend each year because that's what I'm going to have to use to put beans on the table for myself. So there are different parts of life, different circumstances, different investors. Okay, you can get information on how the price has changed over time and also the dividend expectations and so on from the financial reporting that you'll find in financial press, but also online these more and more. It's pretty straightforward to work out what's going on there. Okay, need to distinguish between the different types of shares. We're going to talk primarily about two different types of shares. There's a lot more types of shares than just the two that are listed here. But at least it gets you started. It puts your toe in the water. It gives you an idea that shares in companies, there's more than one style. The most common, less spectacular, and shall we say most ordinary, have a rather dull title of being ordinary shares. And the ordinary shareholders simply takes whatever dividend is available, they accept whatever capital gain is available, and because they're owners in the company, they are able to contribute to the management of the company. As a proportional owner, I might have 1% of the shares in some company, and that means I have 1% of control of that company. And the practical control of companies is done through a structure which really interfaces the shareholders and the management of the company. On one hand, you've got the management of the company leading up to the chief executive officer. On the other hand, you've got the shareholders, might be thousands, sometimes tens of thousands of them, maybe even millions of them. They're then represented by a committee known as a board of directors. The board of directors is made up of representatives of the share market, shareholders. The shareholders vote for them, so it's nice and democratic. And then you've got the shareholders on one side, you've got the management of the company on the other. That's concentrated down to the board of directors on one side, the CEO on the other. And then the board of directors talk to the CEO and they decide where the company's going to go. And that's pretty much the management side. That's pretty important. A lot of people buy shares in companies primarily so that they can develop some sort of influence in the strategic direction of the company, especially bigger investors. That's your ordinary shares. The ordinary shareholder takes a share in the wealth production capacity of the company. It also, as an ordinary shareholder, you take a part of the risks of the company. If the company goes badly, you wear it as lost profits, lost dividends, lost capital growth. If the company goes really, 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 really well, then you get to enjoy the upside, the strong capital growth, the strong dividends, and so on. So the ordinary shareholders are risky, but they're made up with the participation in the return and the participation in the control of the company. Okay. Now, this other type of shares. Now, when I first heard about this, sort of years and years ago when I was first studying business and finance, introduced these preference shares. Preference shares are fantastic little critters because you're still an owner in the company, but you've got a guaranteed dividend. You get the dividend paid to you first before all the ordinary shareholders get to take their share. That seems like a fantastic idea because it means that you've got less risk. And being fundamentally a risk-averse kind of person, that appealed to me when I first saw it. There are some peculiarities about the preference shares. I mean, apart from the fact that they are really, really attractive because of this guarantee, one practical question is, well, what is the guaranteed level of return, of dividend? And because it's perceived as less risky, and there's this perception that less risk means less return, the returns on preference shares tend to be lower. And so the ordinary shares might be returning, let's say, 5% per annum. The preference shareholders might only be earning 3% per annum. But at least they've got that rain, hail or shine, so they don't have to worry. The ordinary shareholders might average 5%. Some years it might be up to 8 or 9%. Other years it might be down to 1 or 2%. And so they've got the roller coaster ride that you just sit pretty as a preference shareholder. Some of the practical curiosities of preference shares is that there are other aspects of the ownership, if you like, of the company that preference shareholders may or may not participate in. So, for instance, preference shareholders may or may not participate in the voting of the board of directors. We refer to that as voting rights. Some preference shares have them, some don't. Some people aren't really cared, so they don't really bothered. So if they get a higher dividend, they don't really mind if they don't vote for the board of directors because they're thinking, well, I only own 1% of the business anyway. I'm not going to be able to really exercise a lot of muscle getting the board of directors, and I just can't trust the people anyway. And so away you go. Okay, so there's the voting rights. The second thing is that we said that the preference shareholders, we said that you might have preference shareholders that have got a guarantee of 3% dividend. Fantastic. What happens if the company is running an 8% profit or thinking about an 8% dividend for all the other ordinary shareholders? Wouldn't it be nice if the preference shareholders said, yes, we've got our 3%, but since the ordinary shareholders are now up around 8 or 9%, wouldn't it be nice if we participate in that upside? Whether fully or partially or what have you, we can negotiate that and put it into the terms of the preference share, the design of the preference share. And that is another difference in the way that some preference shares are designed compared to others, whether they participate or not in the extra profits of the company. So you've got voting rights, you've got participation. Another variant in the way that preference shares are written is in terms of whether or not they go forever. Often preference shares will have a limited life expectancy, so they might only operate for, let's say, 5 years or 10 years. The company might think, yes, for a particular bit of expansion, we're willing to issue some preference shares. We don't really want them there forever. We will offer them for a period of 10 years, and after that the company will undertake to buy them back, usually at some sort of a predetermined price. And so we've got terminating preference shares. Ordinary shares, by contrast, last as long as the company, and that's notionally eternal. How long's eternal, I don't know. But preference shares aren't necessarily going to last for as long as the company. So voting rights, participation in excess profits, and whether or not they're terminating. They're sort of three of the variations, if you like, that you can get with preference shares. Okay, need to probably say a few more things about that. I'll get you to, I think we've talked about a lot already. Preference shares, we've probably talked about a lot already. Now we get to an interesting question. By the time you get an investment in the company, a form of funding to the company, which has a fixed return, a limited life expectancy, and doesn't participate in the management, the democratic organisation of the company, you're looking at something which is starting to look surprisingly much like a bond. Think of what a bond is. It's a loan to the company, fixed term, fixed return, fixed term, in other words, number of years, fixed term, fixed interest rate, and it doesn't make you an owner, so you don't have voting rights. What's the difference between a preference share and a bond? They're not very much at all. It turns out that one of the big differences is the way that tax is dealt with, and I'll let you look at that as a separate issue. And in some cases, it's a disadvantage for the company, because you can claim a tax deduction for your interest expense on your bonds, but you can't claim a tax deduction, the company can't, for the dividends that it pays to its preference shareholders. Well, we're getting a little bit ahead of ourselves. For that reason, by the way, just to finish that point, preference shares went through a period, they still are, not nearly as popular as they used to be because of the tax implications. Okay, let's get to the, whoa, I just realised it's 3:12. I was going to take a break at 3 o'clock so that you guys can go off and have a cup of coffee, and now we're 3:12, so we better take a bit of a break, otherwise you'll be just sort of fading away in front of me here. Let's take a 10-minute break now. We'll come back at let's say 3:20, 3:22, and we'll get started on this again. So take a little bit of a break, go off and pat the dog or whatever you want to do, and we'll be back a little bit later.